Good morning, everyone, and welcome to our second webinar, which is called From Resource to Market, Timor-Leste's Energy Potential and the Future. This is an extremely important webinar, actually with S&P Commodity Insights, and of course with President Dino and Mr. Dominguez being a special guests within this webinar. Thank you so much for joining all, and I hope that you're having a great day. And we're joining from all over the world, from Malaysia, from Timor-Leste, from Europe as well. We have a lot of people who is excited for this webinar. And of course, we have three speakers from S&P Commodity Insights. We're going to have a lot of slides, a lot of presentations going on throughout the webinar. And I cannot wait to start the webinar with you. Starting first, we're going to start with Mr. Dex Wang, the Senior Director, Strategy Development and Benchmark from S&P Commodity Insights. Hello, Dex. How are you?
Hi, everyone. Hi, Karen. Thanks for having us.
Thank you so much for joining. We're going to start with the first presentation with Mr. Dex. I'm just going to add this presentation so everyone can see it right here. Mr. Dex, I'm going to leave it all with you to explain about the actual presentation as well.
Thank you, Karen. And thank you again for all the audience who joined us online. And we'll take you through three presentations, each covering a different topic. I'll be covering the market economics and the way of monetization for future LNG resources of Timor-Leste. And my colleague Megan will give you some updates on the forward-looking fundamentals and pricing. And my colleague Joe will talk about all these from the upstream perspective. So for my part, I'll first give you a very brief intro of S&P Global Commodity Insights. We're one of the 5 divisions of the S&P Global Corporation. We cover mainly on the commodities market, pricing, fundamentals, consulting, conferences, etc. A lot of global companies are our clients, and our prices are used for most of the world's waterborne crude oil transactions. And we publish tens of thousands of price assessments each day, which underpin billions of dollars of commodity trades on the spot market and on the term market, as well as a settlement basis for financial derivatives. And we have the most IOSCO benchmarks in the world, which are underpinning these financial derivatives. Aside from the energy world, actually, we have a lot of expertise that guides companies and entities, political entities, for example, government regulators, along the way, how they operate, how they regulate the market, etc. So that's an introduction. I'll be starting with a view of the contracts with a forward-looking view. So here you're seeing 3 ways of contracting long-term contracts. And I would imagine for most Asian audience, you would be very familiar with the crude oil-linked contracts, as well as in most recent 5 years, more and more Henry Hub-linked contracts have been signed. So I've constructed these contracts with forward-looking pricing, which is our forward curves for the next 10 years. And the construction of Henry Hub-linked contract is a relatively conservative 15% premium on top, and a roughly $4 constant, which, depending on how you look at it, it could be $2.5 tolling fee or liquefaction fee with a $1.5 freight to deliver into East Asia. For Dated Brent linkage, it's a simple 12% slope with no constant. Then you have the JKM superimposed on top. You can see from a forward curve point of view, during the first 3 to 4 years of your 10-year contract, you would see Henry Hub and JKM to be more expensive than a crude oil linked contract. But towards the middle of this 10-year period, prices start to converge, and the forward curve is pointing to a lower Henry Hub linkage for the rest of the contractual period, then the higher contractual value for JKM and crude oil linkage. I have to point out that forward curves are financial derivatives traded on that day, or tradable value on that day. I took them on October 10th. They are not a forecast of future prices. Megan's team do forecasts based on our views of the fundamentals of the market. So when a financial market trades these derivatives, they do not have the very detailed fundamental views of the next 10 years. So I will have to caution that audiences, when you see forward curves, please be reminded they are not a forecast of future prices, but it gives you a very good idea on how the market's view on the financial market would turn out in a long-term contracts. Now think about Timor-Leste supply into this region. Geographically, Timor-Leste is the closest to Asia. You have your major demand sink, for example, the Japan, Korea, Taiwan, China, JKTC market. Then you have the Southeast Asia market, which is relatively smaller compared with JKTC, but it's much closer to Timor-Leste. Then you have the further away market, for example, South Asia. I would imagine 99% of Timor-Leste's output in the future will end up in these markets. So think about how Timor-Leste could be placing your cargo. Your cargoes must be offered at a delivered price that match or beat the incumbent suppliers' offers to the buyers, for the buyers to consider, because otherwise, why would they buy from you? Now, from a buyer's point of view, the incremental demand from any of these three destination regions must pay a DES price that result in an FOB netback for you, Timor-Leste, that matches or beats the existing flow for Timor-Leste to divert cargoes. Say if you already have a economics benchmark which is supplying cargoes to JKTC, if, say, Singapore needs an additional cargo, how would you sell to Singapore? You would see if Singapore can result in an FOB Timor-Leste price that matches or beat whatever JKTC can offer you. So this is the way of thinking from both ends. Then if you think about the incumbent suppliers, Australia, Malaysia, Indonesia, their uncontracted volumes will have to face competition from Timor-Leste once Timor-Leste enters the market. This is actually a very important concept. If we think about just now what we talk about, it's really because for the two LNG basins in the world, there are only two major economic indicators that both buyers and sellers will have to beat or match in order to have that transaction. So in the Asia Pacific basin, it's the Platts JKM. For the buyers in Taiwan, in Korea, in Japan, in China, they don't really care what's your production cost, what's your upstream cost. What they care is, say, your cargo from Greater Sunrise, your cargo from Queensland, your cargo from Bintulu can arrive at my terminal at the most competitive price, which is reflected by the JKM. So that's the Asia Pacific basin's economics. So whether or not Timor-Leste can match JKM will become the most, I would say, the ultimate judgment from the buyer's side on the spot market or short-term market, because majority of the short-term contracts are now linked to the JKM. Now think about term contracts. It's very similar to the spot market in a sense that buyers will need to see at least the same, if not better terms in terms of pricing, in terms of flexibility from Timor-Leste, and to compare that with the incumbent suppliers. Think about Qatari supply to Asia or Australian, Malaysian, Indonesian supplies. Say if the recent term contracts are signed at 12 to 13% crude price with zero constant, is Timor-Leste going to beat that? Because your cargoes will have to be placed amongst these Qatari and Asian cargoes to be delivered into JKTC. So if your crude slope, if you're hoping a crude slope that's higher than whatever that's been recently signing, then you are not going to be able to place your cargo into these markets. Now, Henry Hub, a lot of the, I would say majority of the US cargoes sent into the Asia Pacific markets, linking to the Henry Hub price. You have a 15 to 20% premium. Then you have a constant that can range between $4 to $5. Now, if Timor-Leste wants to use Henry Hub as a pricing benchmark for your cargo, then you have to really match yourself in terms of the premium, in terms of the constant. Something that I do not really recommend, because your cargo is not really US origin, and the Henry Hub price does not represent your cost, your economics. On the short-term market and sometimes on the medium to long-term market, we have contracts linking to the JKM. So a typical JKM contract would be 100% JKM with a minor differential up to about 50 cents plus or minus, depending on the economics. So if Timor-Leste has a short-term contract that you need to sign, or medium-term, or even long-term, and you think about JKM, you will have to match or beat these kind of formula so that the buyers would consider you. And for all these premiums, slopes, everything, it's about comparing your reality against the market and see if you're better, you can charge a premium. If you're not as good, then the market may request a discount from this supplier. And comparing all these benchmarks, I think the most important point to make about Henry Hub is that it's a benchmark that is completely biased against the buyer. So if Timor-Leste is thinking about using Henry Hub to sign contracts to sell to the JKTC market, you have to be prepared to face bias opposition, in a sense that Henry Hub is the only way of pricing LNG that guarantees the cost and margin for the seller, because it's a cost plus kind of model. Every single stage of the value chain is guaranteed in the formula. You have the Henry Hub price, which guarantees your gas source cost. You have the premium, which guarantees getting the gas into the liquefaction plant. You have the constant, which guarantees the tolling fee as well as the freight. And in no other LNG benchmark guarantees seller this kind of security. For example, crude oil, JKM, TTF, without a floor pricing clause in your contract. With crude oil, JKM, and TTF, if these three benchmarks goes to zero, in an extreme case, the contract value becomes zero. But if Henry Hub goes to zero, the buyer still pays the seller $4 to $5. So that makes Henry Hub very unique, that completely protects the seller, which also makes some of the buyers more, I would say, guarded, wary about signing Henry Hub contract, especially if the cargo itself is not from the US. Now think about even longer term. How do you determine your slope if you're signing a long-term contract? I think a forward view of the LNG price as well as crude oil price is the most direct and, I would say, neutral way of thinking about these future values. You simply calculate the implied slope for the period that we're talking about. Say if Timor-Leste has a contract that goes from 2030 to 2040 to Japan, for example, a 10-year contract. You use the average price of JKM forward curve or JKM forecast and divide that with the average price of crude oil during 2030 to 2040. Whether you want to use forward curve or forecast, it's up to you. And you can calculate that implied slope. You can see the shape of the implied slope is really interesting because on the front end, LNG appears to be relatively more expensive compared with crude oil curves. Well, it sort of softens towards the fourth year and softens all the way until the end of the 20-year period that we're looking at. And say if you're negotiating something on October 10th and the forward curve is telling you if a 20-year contract spanning 2026 to 2045 would roughly have a forward curve value of 12% slope, which I imagine is quite close to whatever people have been negotiating. I'm not saying these forward curves are the most important input in calculating or negotiating these slopes, but they do form a very interesting input, especially considering both JKM and crude oil forward curves operate on their own. They typically don't tend to influence each other, so these calculations can be considered completely neutral. But in general, because we haven't entered into an oversupplied market, which Megan will discuss in detail later, you can see that on the front end, with the higher front end price of LNG, if you have two contracts that starts at the same time, the shorter one will have a higher slope. If you have two contracts that are of the same length, say 10 years, the one that starts earlier will have a higher slope. This whole situation may not last when Timor-Leste volume comes up, because the market will enter a phase of balanced and oversupply situation in the next few years. And all this shape will change. So this is another way of thinking about market sentiment. Now I'm using the forecasts. So Megan's team forecast JKM price, and our crude oil colleagues forecast crude oil price. If you do the same implied slope calculation, you can see the implied slope weakens and bottoms in 2030. I'm not saying 8.85 will be the slope. I highly doubt any seller would accept such slope, but this is a very good way of thinking about market sentiment. So sentiment currently points to a bottom of 2030. For buyers, I think they will rush to sign contracts before that, at least, or start their contract before that, because once after 2030, the sellers, the suppliers will have the ground to say that the market is tightening, you're supposed to pay me more. Just one thing on the commoditization of the LNG market. We've seen great changes in the past, I would say 5 years, when the shorter term contracts have almost completely commoditized, meaning LNG trading against LNG price. So for anything that's between 30 days to 2 years out, majority of the volume during this period is pricing against an LNG price in Asia. Anything beyond 2 years is where you still have the traditional non-market-based pricing, for example, using crude oil, using other benchmarks, for example, Henry Hub. So the commoditization sort of stalled at that 2-year mark. And whether the market-based transaction will happen for the longer contract, it remains to be seen, because I think in a very volatile market, people still prefer to use what they think as a stable benchmark, and they perceive crude oil price to be a stable price compared with an LNG price. Whether that's true, it remains to be debated. One last thing before I end is thinking about long-term contracts. How much do you want to lock yourself in a huge ultra long-term contracts? Yes, it guarantees outlets for seller or guarantees supply for the buyer, but you're also linking yourself to a very big financial risk, because what if the contract was signed at an unfavorable term? You are not able to change it for the next 10 years or 20 years. So I think breaking down big volume into smaller contracts helps, and also breaking down very long-term contracts into shorter contract helps. It gives you the flexibility, and also try to diversify pricing. We've already seen this. Some 5-year contracts are now very common. You see that buyers have been requesting hybrid pricing, for example, 50% Henry Hub, 50% crude oil, or 50% JKM, 50% crude oil. So all these kind of experiment and innovations, I think it's good to see that buyers realize that a non-market-based pricing has its benefits and risks. And also when you think about price reviews, because if you're linking it to crude oil, it's prone to see that crude oil price diverge from LNG, and the underlying LNG price is the benchmark that you think about the value of your contract. So if crude oil price diverges from LNG price, you want to conduct a review. I would suggest to write the review clause to be as frequent as possible. I know logistically, financially, it's very costly, but I would recommend that you continuously stay closer to the true value of LNG instead of letting the contract to diverge in terms of pricing. And that is all from me. Thank you very much. I'll hand it to Megan.
Great. Thank you so much, Dex, for your presentation and slides. Of course, there's a lot of things that you talked about and a lot of topics. And of course, we're going to have at the end a Q&A with President Dino and Mr. Dominicas as well. Moving on to Ms. Megan Jenkins, which is the Associate Director, Global LNG from S&P Commodity Insights as well. Ms. Megan, good morning. How are you?
Good, I'm doing great. Thank you so much for having me today. And thank you, Dex, for all of the content you've shared and the quick introduction that you've gave as well for the research that my team does. So I'm based in Singapore. My team is part of the global LNG team at S&P Global Commodity Insights. In particular, what my team looks at is the fundamentals and the forecasting for Asian LNG markets. So in today's presentation, I'm going to be sharing a lot of these fundamentals, as Dex has explained, our global LNG supply, as well as our global LNG demand forecast. And then I'm going to emphasize how Asian demand and Pacific Basin supply fits into the global market. And at the end, I'll be sharing our expectations for oversupply, which Dex has already mentioned, and what types of challenges this can bring for the industry. So to start off with here, first I'm showing our global LNG supply forecast broken down by where the supply is coming from by the basin. We have here shown blue Pacific, the orange Middle East, and the pink Atlantic Mediterranean basins. Most prominently, what we can see here in this graph is that the LNG market is a growth market in the long term. This is different from our global gas. So gas in regasified state compared with LNG. Our global gas market, gas demand will be peaking and declining in the long term with progress on the energy transition in our base case. However, this base case still expects LNG to grow continuously through 2050. A major reason for this is that in our emerging markets that will be driving this growth, there will be a decline in domestic gas production, and they will be more reliant on imports from LNG to meet their energy needs. Now, as to the extent of this growth, LNG, the market size has just passed the 400 million ton mark in 2024, and we expect it to nearly double to a little less than 800 million tons by 2050. So this is a very optimistic figure, but not all regions will experience the same level of expansion as the market as a whole. And this is true particularly here in Asia, in our Pacific supply basin, shown in the blue on the bottom. So the Pacific basin historically has accounted for around 40, a little more than 40% of global supply in 2020. But we can see in the long term that growth in this basin is not as prominent, especially as what we're seeing in the Atlantic Mediterranean or Middle East. This growth in Pacific Basin will be outpaced, particularly by the United States and Qatar in the Middle East. The United States this year has reached a record number of FIDs for export projects. They are already the largest exporting country in the world and will remain so in our base case in the long term. And Qatar has recently overtaken Australia as the second largest LNG exporting country. So in the long term, this supply mix will change fundamentally, and we're expecting Pacific Basin supply. It will continue to grow, but at a more moderate rate and lose market share, dropping to a little below 30%, 28% by 2050 in the long term. Now in this slide, I'm going to switch to talk about our demand forecast. We're seeing a different trend here. Asian markets are already dominant in as LNG consumers. And then in the long term, they will become an even larger share. So this graph, we're showing demand by region, Europe on the bottom in blue, JKT, this is Japan, Korea, Taiwan, our mature Asian markets in the orange, and then emerging Asia shown in pink, followed by our Americas and our other markets on the top of this graph. We can see that the JKT region, these mature markets, in the long term will actually decline slightly. The reason for this is Japan, Korea will increasingly use renewable and nuclear power, which will displace gas in the power sector. This will actually outweigh long-term growth in Taiwan. Um, as a block, it will be an overall decline from current levels. Emerging Asia, who do we include here? China will be a major driver of this growth through the end of the decade in the near term. But Chinese demand, even Chinese LNG demand, will eventually peak in the 2030s, after which Chinese growth will plateau and decline and give way to growth in the next tranche of development, which will be from South and Southeast Asia. This is these numbers are drawing from the research from our regional experts who have been looking at local gas, power markets, resource availability, policies. What we're seeing, especially in this part of the world, is a widespread trend and intention from these governments to gasify the power sector, to move away from coal, not only for air pollution reasons, but also to peak carbon emissions, and this is underpinned in this region, particular by strong organic economic growth, growing populations, will all support gas and LNG demand in these markets. Furthermore, as I mentioned in the first slide, in this emerging Asia, particularly in Southeast Asia, this is another area we are seeing the trend of declining domestic gas production, also magnifying the effect of reliance on LNG as an energy source. So by 2050, we can see in Asia, if we add up JKT in this emerging Asia region, 70% of our expected demand here will be in the APAC region. So to return back to my previous comment as well about these mature markets. So mature markets, I'm including the markets with long-term decline, Japan, Korea, and China. Um, China is going to grow quickly in the near term, but decline in the long term. So I've put it here with mature markets for this analysis sake. Even in these markets, I also want to highlight that just because we are not seeing long-term growth, a line moving straight up in the long term, this does not necessarily mean there is no opportunity in these markets to sell and contract LNG. This graph here, we are comparing their existing contracts, their SPAs, versus our expectation for LNG demand shown in the black line on the graph. As we see the SPAs, or the shaded region of this graph, it's going to start declining in the long term. And this is because existing contracts, which are often signed for a period of, in the long case, of 20-25 years, in the short case, maybe 5 years, many of these foundational contracts are set to expire as we approach the 2030s. And this gap between demand and contracted supply will widen. Creates opportunity for contracting even in non-growth markets. Now, who has supplied this gas historically? Pacific Basin I show in the blue. It has been a foundational source, but I also want to highlight here as well that um, other includes categories like portfolio players. The reason we mark them as other is that the contract may not be signed with designated Pacific Basin supply. It could be any supply in the world, including Pacific Basin. But if we actually look at historical deliveries in Japan, South Korea, and China, where the gas comes from, 70% of their deliveries in 2024 have come from the Pacific Basin. So much of this other is actually being sourced in the region. And this is because portfolio players can take an optimization approach and bring gas that is close to the market to demand that is closer to their resources. In the long term, it is logical for us to assume that with most new supply coming from outside Asia, non-Pacific supply sources will grow as a supply source, But for the supply that is here, there is really a case to be made that this is competitive supply, just given the proximity to the markets as well as the shorter shipping distance and how that can contribute to cost savings. Now, at the end of my presentation, I want to talk now, switching gears to this question of oversupply, which Dex has already mentioned. The way that we'll talk about oversupply today is I'm going to put our supply and demand outlooks in a graph in context of each other. So we can see how the growth of each is proceeding. With this rapid influx of new liquefaction projects, particularly from the United States, aiming to come online by the end of the decade, what we are seeing is a risk of supply growth outpacing that of demand, leading to a surplus. The way we show this in this chart is we have our base case demand outlook shown with the black line, and we have a gray range listed atop and below. What this is showing is a 5% plus or minus uncertainty on top of our demand forecast. When our supply line falls within 5%, we consider the market to be roughly balanced. When supply exceeds this 5% zone, we forecast risk of oversupply. Now we have two blue lines here. The first one is dotted. The dotted blue line is showing our existing and under construction projects, liquefaction projects. Now these projects alone, if no other project starts construction, we can see that this is sufficient to meet our demand expectations till around 2031, but after which we do forecast the market will need more projects to meet growing LNG demand, from projects that have already taken FID to begin construction or new FIDs. The solid blue line here, what this is showing is the projects in our FID forecast. So they have not necessarily kicked off yet, but we expect that if they come to market at the expected rate, how much supply will this bring to the market? Our blue line in the solid case begins exceeding the gray zone by 2029 and is outside this zone through 2031. So this is where our base case forecast is expecting market surplus. And market surplus is defined by low prices. We're forecasting Asian spot to dip below $6 on an annual average by 2030, with very low price compared with what we're seeing now. United States producers in the Gulf Coast will be experiencing shut-ins, will be uneconomical during this period, during the summer months with such low prices. However, I also need to caveat here, this is our July forecast. We do this forecast twice a year. The difficulty of doing a forecast twice per year is that in a rapidly changing market, your numbers become very quickly out of date. Since that we have done this forecast, we've seen an additional set of projects in the United States take FID, amounting to nearly 20 million tons per annum of liquefaction capacity. Now, these were previously not in our forecast. So you can imagine this, a global LNG supply line in reality should be even higher than what we are showing in this graph. Now, what does this mean for demand? If prices have even lower pressure, it is logical for us to assume that demand can increase with lower prices. Right now, our team is modeling this and how much more demand we can see emerging in price-sensitive markets. But what I need to highlight here as well is this is a cyclical market. Low price, it spurs on demand, but it also limits new investment. So these two factors here are what brings the market back into balance. In the next few years, with more FIDs, with more capacity coming online, we really do expect that this will put a lot of pressure on subsequent projects who are trying to FID. Low price environment will be difficult to secure financing. The market from a seller's perspective will be very competitive to sell LNG with so many other projects bringing their molecule to the market. And this is what we want to highlight and end the presentation here today is low price can be good for demand, but it can also be challenging in the rapidly changing market right now. So with that, I will wrap up my presentation and pass on to my colleague Joe to talk about the upstream. Thank you very much.
Great. Thank you so much, Megan, for your presentation. It was a great presentation so far, and we learned indeed a lot of things as well. So with our final presentation with Joe Keith, the actual Associate Director Technical Research from S&P Global Commodity Insights as well. Joe, thank you so much for joining us. How are you today?
Very good, thank you. Yeah, it's a pleasure to join this session.
Great, thank you, Joe. I'm leaving you with your presentation as well, so you can walk us through it as well. Great.
Super job, thanks very much. Yeah, I'm part of the S&P Global Commodity Insights upstream research and analytics team, particular focus on Oceania, and really taking the opportunity through this session to introduce Timor-Leste from an upstream perspective. So what's been discovered, produced, and what's the remaining potential, and how some of the current projects are defining the outlook. So there have been a modest number of discoveries made in Timor-Leste since the 1960s. 90% of those resources lay across just 4 fields. Only 1 field above 30 million barrels of oil equivalent has actually been developed so far, and that was Bayu-Undan, which was shut in June 2025. But the upside and the good news for the country is that there are still more resources left to be developed than have been produced. At least 60% of the discovered resources remains in the ground, and that's without additional exploration, which is expected to come and boost those resources. If we assume that the global average of around 15% of discoveries will remain stranded, there's still over 1,000 million barrels of oil equivalent in Timor-Leste to be developed. Of course, there are challenges with development timelines that we've seen. 95% of the country's resources were discovered before the turn of the century, and most remain without sanctioned developments. But if we take an analog example like the Browse Basin, it's become a very strategically important basin. It has large resources. I mean, it's 3 times larger than Timor-Leste. Kind of puts it into a slightly different perspective, but even for that basin took over 40 years for commercial production to commence through LNG projects. So finding the right investment opportunity at the right time is key, and that's, I think, why we're all excited for Timor-Leste at the moment. LNG markets, has already been discussed, will require additional supply to meet growing demand, particularly across Asia. And we've seen that investment in upstream is returning, particularly in supporting of global energy security. There are, of course, a number of additional smaller onshore oil and gas production to come. Offshore oil production is also on the cusp of being realised, and that's very exciting for the country's future. And there's undoubtedly remaining upside, particularly offshore along the Jurassic gas trend from the Calder Graben to the shore platform, hosting already fields like Abadi, Sunrise, and Chudich. There are also delineated untested prospects throughout the region, particularly in the Flamingo syncline, where multiple majors have already explored, and along frontier basins as well, such as the Timor Trough, which contains existing seismic data, which is very important, and offers prospectivity in stacked Jurassic, Triassic, and Permian levels, has already been mapped by Timor Gap in a recent campaign. I guess that leads me on to the key trend for creating further upside potential is through the harnessing of existing data, and reprocessing of seismic data in particular has already been a game changer for Timor-Leste. So this has been a proven strategy by current explorers, including Sunder Energy, for expanding the Chudich in terms of reserves and in area, and improving future well placement. For Finder Energy, increasing the contingent resources base to boost the development scenarios at Kudetasi and Jahal, plus upside options to come. And for Timor Gap in the frontier exploration areas of the Timor Basin. Something which we know is being supported by AMP to deliver new analysis for unlicensed discoveries as well, such as the Kelp Deep, which has seen some target refinements across stacked reservoirs through improved seismic interpretation. The field size distribution that we see across Timor-Leste certainly suggests that the yet defined resources are significant. From the existing projects outlined, I guess, for development over the next 2 to 5 years, there's already the potential to grow peak production beyond that's already been achieved. Projects are yet to be sanctioned, so that the timelines are a little blurry, but a broad outlook from the late 2020s to the early 2030s could see high hydrocarbon production around 30% higher than the last peak we saw in 2012, driven by Bayu-Undan and the Kaitan fields. Plus, as I mentioned, there is additional upside potential expected, not only from exploration, but surrounding the projects also through infield and also near field level, which could be realized through future asset understandings, through additional appraisal and also exploration programs. Going from a current production base of zero, the immediate benefits are perhaps obvious, delivering revenue to investors and government. Also, a local workforce and equipment supply will be essential, especially through the development phase of these new projects. And with that large, particularly for gas volumes, reaching the market, new infrastructure requirements will provide significant opportunities for LNG exports and also for domestic gas supply to replace, or for electricity generation, and also to replace heavy fuels, reducing the cost and also progressing that pathway to decarbonisation. This is my last slide. It's just to look at Timor-Leste's potential for a further bid round to increase the investment opportunities, to attract new upstream players into the country. And these bid rounds are certainly a key tool used globally. It's been shown over the last few years, there's still an appetite for exploration as operators and governments are prioritizing energy security alongside the energy transition. There are continuous fluctuations in defining what we would call a normal level of activity. Things are much quieter in the upstream industry than they used to be. We know this. The last reset seems to be around 2021. And with this as a reference point, activity globally has been picking up. And for Southeast Asia, mature basins have continued to deliver. There's also room for reworking and redefining emerging plays within these basins, and also carrying out frontier exploration as well. Bid rounds have been scaled back over the past 5 years or so, whereas offerings for near field exploration in mature basins is becoming more common. There's also been an increased weighting towards frontier basins and a growing proportion of deep water blocks being made available in countries such as Brazil and along the Atlantic margin. Both trends would suit Timor-Leste moving forward into 2026. Through 2025, it's expected to see around about 40 countries holding bid rounds, and many of which will be looking to change terms to improve investment and future production opportunities. Operators are often working on balancing opportunities across global portfolios, and so expected to enter into a lower price environment over the next 12 months. Whether at higher exploration risks and economic challenges, continued benchmarking will certainly be very important to guide new investment decisions. So I'm certainly looking forward to seeing what's around the corner for the region and for Timor-Leste. And that's all I have for that. I'd like to pass it back across. Thanks very much.
Great. Thank you, Joe, so much for the presentation. There was a lot of slides. And thank you all for, of course, Ms. Megan and Dex as well for the slides that was shown. President Dino and Mr. Dominguez, right now we're going to have a short Q&A. Of course, sadly, Dex has to leave the actual webinar as well. I'm sure we have a lot of questions for Dex. However, of course, we're going to ask him later on at another day as well. From the audience, we have a lot of questions as well that I'm going to forward to the S&P team. But for now, President Dino or Mr. Dominguez as well, if you can let us know your questions regarding Ms. Megan and Joe's presentation as well. President Dino, what do you think regarding the slides, of course?
Thank you, Karam. Thank you. First of all, good morning to everyone, all the audience, particularly to the speakers from S&P as one of the co-hosts for the upcoming Timor-Leste summit. It's 30th of October today, so roughly another month. So thank you for colleagues from S&P, from Mr. Dex and Ms. Megan, as well as Ms. Joe Keith, for the times and efforts put into the materials you have presented today, which is very, very, very insightful and informative for us. So thank you so much for your efforts and your times. Perhaps I'll begin with an observation by sharing some backgrounds as well as facts and figures of what's going on today in Timor in terms of the petroleum activities. And also towards the end, I will have perhaps two slide questions, one for Joe and one for Megan, perhaps. So in Timor-Leste today, we are in preparation for the next summit, of course, the next bid round, of course. Allow me to share that perhaps starting from the preparation for the bid round itself. Joe, it was very insightful from your end and based on the information that you've gathered on the potentials, resource potentials we have, as well as the projection or plans for the bid round next year globally. So that is helpful. That's very helpful. Now, from Timor-Leste, as part of the preparation, the last, I would say, 16 months, we've been focusing on reviewing the potentials we have. You would recall that Timor-Leste, for the areas which were subject to the Joint Petroleum Development Area, came into 100% jurisdiction following the entry into force of the Maritime Boundary Treaty between Timor-Leste and Australia on the 30th of August 2019. Now, ever since we had more control, one decisions from Timor-Leste, as opposed to getting consensus with Australia under the so-called JPDA regime. So from there on, Timor-Leste had that, I would say, full control. But then we have COVID, of course. Yeah. So things didn't get out quite as what we wished. No? So, but now that we have gone over COVID and the market more or less, the industry more or less resettled. In the last 16 months, we've been focusing on reviewing the potentials we have. This including looking at the each of the wells. We conducted dry hole analysis for over 60 wells we have in our area, as well as looking at the seismics again, all the reports, all the seismics again, and some production data for the for former producing fields. And now we are very much ready. We have remapped. We have remapped the prospects and leads. Now we have a new maps of prospects and leads for our areas, and also you mentioned that having a good thing is having a seismic 3D seismic reprocessing. Yes, in fact, we are in discussions with colleagues from TGS. This is one of the plans as well, to actually make sure that we have new reprocessed data, hopefully by or before the next bid round. So this will take some time. Maybe throughout the bid round, we will have, hopefully, we will have also the new data. Most of the areas offshore particularly. But we are also doing a reassessment of all the data we have gathered, geophysical data we have gathered from onshore. So we're pretty much ready for both offshore and onshore by way of studies. We have a better study, improved data, if you like. In the area of regime, contractual regime as well as fiscal regime, you rightfully said, many countries tend to do that from time to time to offer better terms. Similarly, Timor-Leste is also focusing on that. I am yet to disclose to what extent the changes are, but I can share in this forum that Timor-Leste is focusing on providing incentives proportionally to the areas we have in offshore and onshore. What I mean by that, we look at the water depth. So we look at the water depth. We also look at the geological complexities. From one region to another. Further down the south, in Bayundan up to Sunrise areas, is well proven. And the geology is pretty straightforward, of course, compared to those moving towards the trough, and also beyond the trough to the north, where we have accretionary wedges, is another degree of complexity in there, and also the onshore. So in sum, we have divided the areas into 5 domains. So these 5 domains have the different play types, but also they have a different complexities, and therefore they have different incentive package. So by way of contract fiscal as well as fiscal taxations. So it's quite a comprehensive reform, hopefully, in Timor-Leste's petroleum industry history. We hope that all the approval process progressed according to the schedule, so that before we do our bid round, we have all this in place for our investors. So looking good on that end, of course. But in some, so the question would be for Joe, in your experience as well as dealing a lot of analysis, gathering a lot of information from other countries globally or also in the region, what else do you think Timor-Leste will need to prepare to ensure that while we have a lot of host governments opening up the bid round, but Timor-Leste can be seen as one of the soft or good targets, if you like, in terms of investment. Obviously, we have the good records of the good governance, because we adhere to the GITI mechanisms, and the way we manage our fund, also very transparent. So from that perspective, good operationally, we have been also good, because by Hundan, from day one in 2002 to its cessation in June, no fatalities. The HSE record is good. It is fully managed by Timor-Leste regulatory body. This is a non-technical issue, but they matters. And they are matter in terms of building trust, or building trust with the investors. I think Vice President Domingos will touch on it, but let me just quickly also give some hints that from the government perspective, government has also invested a lot and has started a campaign of introducing more enablers. That is the supporting infrastructures. Yeah, how can we better monetize our resources? Because one of the other reasons why we actually change that into domains, because some fields are actually marginal fields. We have oil marginal fields and gas marginal fields. They also need specific treatment, specific regimes. They should not be treated as any others, including the depleted fields, such as Kitan, Bayundan, Buffalo, EKKN. So we have special regime for all of each one of them. So that they did for this group, these depleted or marginal fields. So not to mention that in terms of the producing reservoirs, we have mainly Jurassic so far, but also, as we know, we have a Permian reservoir. That is the one with kelp dip, where we have the gas there. Of course, we have CO2 in there, but we have facility. We have a Bayundan facility in there, and we also have reservoir ready for receiving this CO2. So the idea, the parameters are there. The attributes are there, open for discussion now. So to sum, I think. The enablers, another important enabler that the government has put into clear actions, very clear timelines, as also investment is the infrastructures, supporting infrastructures. Yeah, we have already had in place a functioning airport in the south coast in Suai area, but also soon to be constructed supply base and also highway linking to the east, where we will have all this petroleum infrastructure downstream complex, ranging from LNG plant to petrochemicals industries. So advanced studies and investments are taking place. These are the efforts the government have put in place collectively to welcome the investment. So we should give more value added to the investments, so open up. So with those background, let me also ask Joe once again that in your views and assessment, now there's a lot of data and information from other countries. What are the other matters that you think, or attributes, and what is the best or not best, but perhaps what is your advice? Is there anything that Timor need to take into consideration by way of designing its preparation for the next bid round, whether it is technically, legal, or commercial? Welcome your views on that. Whereas with Megan, I appreciated very much your assessment, your analysis on the supply and the demand for the LNG globally, as well as in the Asia and Southeast Asia region. So that's with colleagues from DEX. I think DEX also had a very good coverage, in my views, very comprehensive on the LNG pricing, as well as contracting strategies, etc. So thank you all for that. But I would be just maybe appreciate if you could also share your views. I hear about you mentioned about China, of course, Asia, but the single out China, where that long term is actually looking, short term is looking good, but then long term is actually declining. And you also mentioned, if I hear correctly, that the use of nuclear energy is the trigger. Perhaps I would greatly appreciate if you can also qualify that assessment from the view of waste management, as well as from the view of technology in place, comparing this LNG with the nuclear technology. I also didn't hear your analysis in Asia on the Japan market and Korean market, where Timor-Leste has been in the past. With Hyundai in particular, they have known our product. Timor-Leste's product, of course, back then it was known as JPDA, and LNG even known as Australia, because it was registered in Australia. But out of Darwin LNG, but it is actually a product from Timor-Leste as it is now. So we'll be glad to hear your views as well on that end, just to give us some ideas in terms of the projections or possibilities or opportunities in the future. I'll stop in there. Hope that helps. Thank you very much.
Great. Thank you, President Dina, for your questions. I mean, Joe, let's start with you answering the specific questions with President Dina as well.
Yeah, happy to. That was such a comprehensive overview of where things are at the moment and where things could be going over the next 12 plus months. Yeah, very, very insightful. And I think a lot of what Mr. Dino da Silva just said, I think resonates with me in terms of what would drive new investment and for new entries, particularly into the upstream sector, to drive that next wave of exploration and ultimately production. We've touched on the terms that may well be changed based on industry feedback, and I think one component of that would be critical to track project life cycles, so to be able to apply terms that can look after not only the exploration in frontier areas, but also, as mentioned, the opportunities for mature assets as well. So whether that's a redevelopment at some stage of Bayu-Undan, revisiting Buffalo, is there still oil there to be produced? And if so, not just having stable terms that give investor confidence, but also having those life cycle terms, opportunities as well, particularly as assets are in decline or being mature assets being redeveloped. I think that's very important, and also looking at entry conditions as well for operators, as already discussed, considering terms based on the situation or terrain, based on the expected geology, reservoir conditions, and also access to infrastructure as well. So we know that work is already ongoing, and look forward to seeing what is offered eventually ahead of the next bid round. I guess as part of that is looking at those tax incentives for marginal fields, looking at increased incentives for high capital cost projects like isolated gas developments. Would certainly be very key. And I think just on my last note with that, I suppose, with looking at marginal fields or fields which are without existing infrastructure, it's the ability to aggregate resources. I think will be key. That's maybe a little bit further in the distance for Timor-Leste, and you need to get that first production back up and running, particularly in the offshore scenario. But just looking ahead and having that foresight of having aggregated resources for development, I think will be key, particularly the capital costs for connecting the offshore fields to an onshore facility will likely be significantly higher than the total in-field development costs. That outlay for pipeline and required infrastructure is going to be high. So having that collaboration between government providing the right incentives, and also the support as well that we're seeing coming through Timor Gap with early exploration entry, but now also significantly increasing their pre-development and development cost support for operators. Is certainly going to be even more key moving forward as projects advance through into that development and production stage. Hopefully that answers some of the questions that came through. I know that there was also a point that came through there that Megan, I think, will be best positioned to answer regarding the markets through Asia.
Thank you, Joe.
Sure. Thank you so much, Joe. Ms. Megan, what do you think regarding, of course, President Zdeno questions and your insights regarding that market as well?
Right. So it's an interesting question. I just want to highlight as I answer this. It's complex to talk about so many different markets. They all have very different trends. So just to clarify what I had meant in the earlier part of the presentation. So in the case of China, this is an interesting market in that it will grow in the near term, but eventually decline in the long term. What are the reasons for this in terms of LNG demand? The reason we're looking at this long-term decline in China, first of all, from a economic basis, the Chinese economy is transitioning from higher intensive energy consuming industries to lower energy consuming industries. So as a whole, as the market, the economy grows, it's natural for GDP growth to slow down. But as well, we're also seeing this industrial transition from higher consuming to lower consuming energies and industries. So what this means for LNG demand growth in the long term is moderating trend in the case of China. In the power markets, in addition to the slowing growth, Chinese power market is putting on record number of renewable generation resources every year. And so we're really seeing a case in the long term in China, numbers that continue to surprise analysts year after year. And this record-setting number year after year of renewable additions is something that we believe in the long term will fundamentally constrain natural gas consumption from the power side. So economic transition, the energy consuming industries will be fundamentally changing. And then in the power sector as well, we're seeing changing generation sources. Renewables will be a major part of this. China is also pursuing nuclear, but I would not call that, compared with Japan and Korea, the major part of the story. Japan and Korea, this is a case where there is a return to nuclear power in the long term that will be a major constraint for gas demand. Furthermore, they're also pursuing renewable energy resources, but the nuclear restarts in Japan, South Korea is also interested in increasing its share of nuclear power. This is in Japan and Korea much more a story of nuclear in the long term being a fundamental constraint. We did, interestingly, compared with our last forecast, we did increase our expectation for Japanese and for Korean LNG demand in the long term. And this assumption is that we're thinking they will take more power away from coal-fired generation. But the general story is that, the nuclear restart is something that is a fundamental limitation in the Japanese and in the Korean markets.
Great.
Thank you, Joe. Thank you, Megan. Thank you.
Great. Thank you, Megan, as well for your answers. I feel like there's a lot of insights, and there's a lot of things as well regarding Timor-Leste. Mr. Dominigos goes to you as well. Welcome to the actual webinar from Timor Gap. So thank you for joining. And I would like to ask you if you have any kind of questions regarding the slides and the presentations that Ms. Megan and Joe has shared as well.
Yeah, thank you, Karam. And because of, I think we're running out of time here. But yeah, thank you both and Dex, who already left, for the insightful presentation. The information that you shared with us indeed is very good, especially for us as the NOC of the country. It's good to see what the views from someone who's outside there what we're doing. Just a couple of questions for you both. Also, maybe one question for Dex, but that's probably later on. We can just do it remotely. Question for Megan. So you mentioned a lot about the supply and demand, and looks like would be oversupply, and with the growing LNG in the US, it looks like the market will be quite saturated, especially in the region. So I just want to ask you, what's your view if there is any potential or opportunity at all for us, like Timor-Leste, to meet, or at least to help meet this growing demand, although with the oversupply in the market. I'm looking also not only in the emerging market, but also with this mature market, if there is any possibility or potential for us to actually tap into that market. And perhaps maybe if you could answer also, or maybe it's more for Dex, one thing about the contracts, long-term contracts, what we've been hearing that it's becoming less and less, and more on the spot or short-term contracts. So what's your view? Is there any likelihood for us, if we are to go more for the long-term contract, the success is there or not? And one quick one for Joe. Thank you for sharing what you already shared with us. Very, very informative and very good to hear that. Just one quick question. What do you see on top of what you already mentioned about the Timor Gap's active role in that? As they only see, if you, from your experience, any other insights or things that we should do more to basically maximize the potential exploitation of the resources that is still out there, which is, according to your word, it's a quite modest discovery or that. So any more advice on that will be highly appreciated. Thank you, and over.
Great. Thank you so much, Mr. Dominigas. I think your questions are on point, and thank you so much for your insights as well. Ms. Megan, starting with you, what do you think regarding the questions that Mr. Dominigas has shared with us?
Right. You brought up a lot of great points. From my view, it's certainly a challenge, especially right now because of this emerging oversupply in the market. I shared in my presentation that there is demand. There is demand in Asia from the growing markets, but also from the mature markets because of the contract expiration. So even if the demand is not growing, the amount of the gap between the contracted supply and the projected demand is that gap is going to grow. So there is room to sell gas even in the mature markets. And of course, there's room to sell in the growing markets. The problem is there's also a lot of competition. So what we're seeing right now is, in a very competitive environment, LNG sellers are all looking at different ways to differentiate themselves. Part of the way to differentiate could be in your contracting strategy, the price linkage that you offer. This is something that Dex has been talking about in the first part of the presentation. Another part of this is the flexibility terms that you give to your buyers. What we've seen in Asia is there's some differing trends. Some buyers, they need cost to be low because there's an affordability concern. Some buyers, though, for example, in these maturing markets, there's a lot of questions fundamentally that they're asking themselves about how much demand will fall off. Will it plateau? Will it decline even further? These types of markets, for example, in China, for example, in Japan or in Korea, the pace of this decline, they have higher degree of affordability, but they need more flexibility, especially in the long term. So the duration of the contract, some buyers want shorter duration contracts, some they want longer, but with more flexible delivery terms. So again, this is something that, depending on who you're selling the supply to as an LNG, as a liquefaction project, it's meeting the needs of the buyer. There's many different ways to do this, and DEX has certainly listed out on the contract side, from destination flexibility or the pricing linkage, how to accomplish this. Buyers also are looking at diversifying their portfolios. If a buyer has too much exposure in one particular basin or one particular buyer, they might also seek out other suppliers just from a diversity standpoint. So really, this is a competitive environment, and as these projects that are trying to reach FID will really need to identify how they can differentiate themselves in an environment that is becoming more and more dominated by incremental supply by US and by Qatar. How your supply can respond in context of the two majors that are really starting to grow their market share.
Great. Thank you so much, Ms. Megan, for your answers. Of course, there was a lot of insightful information with your answers that you have provided with us as well, especially regarding the US and Qatar. Back to Joe, what do you think regarding the points that Mr. Dominicos has covered with this question as well?
Yes, thanks, and good question raised. I think of looking how to improve or maximize the resource potential, and how can that be developed quicker, or what incentives can be applied to try and promote projects faster. I mean, that's, I guess, a question that is being asked in many jurisdictions across the world at the moment, and I think particularly in areas where exploration or production has been declining. So for Timor-Leste, the production has been declining since 2012, and the level of exploration has also been fairly low. But one area that I think has already seen has been extremely positive, and I think something that will certainly continue from what I can see is the level of activity from the existing players, though, in Timor-Leste. So we see in some other regions, once activity drops and is pretty low, in order to try and boost investment, see companies come through that don't necessarily have that same exploration drive. It's more looking at pure investment opportunities. So coming through, either looking at near field land grabs, if you like, or looking at frontier areas. Potentially something will be reworked up nearby, and then through the investments that's already been made, you can start to look at farm out opportunities or divestment opportunities to return the outlay. But that's not been happening in Timor-Leste. The new players have been very active, and that's been a very good drive for promoting the opportunities, not only for exploration but for production. So the other part of that as well, I think, is the access to government support, but also finances as well, is key. So that something else that has already been seen. So we look at the entry positions that Timor Gap have made over the past few years has been significant. So we've talked before about how to monetize marginal assets, and a big part of that is either to provide capital assistance, or to provide significant incentives to help monetize assets that may not be relying purely on large resources. So that's something that we may well see next year. I'm sure that we will, but for the time being, it's the capital boost for new developments that I think will certainly help drive the new production stance for Timor-Leste in the next couple of years or so. Component, I think, which would probably be more important once production and developments actually start to take place. We're just waiting for those first final investment decisions to come through. But once we see that, it's going to be creating access to market, particularly in a gas case. I know that's something that is being considered, but there are lots of opportunities and lots of different types of projects that can be available both onshore and offshore for maximizing small gas projects, but also very large. So either large going to LNG or small looking at domestic electricity generation, which will not only drive those initial projects forwards. So look at the onshore Timor-Leste by Timor Resources, and those potential developments could initiate a new market for future exploration, future success, particularly in the offshore scenario. So again, something that maybe we're looking a bit too far in the future for, but having those in the pipeline, I think is important, and hearing plans from government to have infrastructure available to bring resources to market is also very important. And I guess just lastly, I'll just make a comment on the ability to share resources, and also sort of more of like an equipment-based sharing arrangements. If you look at bringing a rig, for instance, through into the waters of Timor-Leste, there aren't many rigs around in the region. It takes time, it takes money to bring them through. So you bring a rig in, for instance, for a development, for an appraisal campaign. What other opportunities are there? Are there potential exploration wells that are being considered? Can there be some shared work program, or ensure that the rig coming through into the region is adaptable to do both appraisal and exploration based on the water depth and the targets that are envisaged by the operators. So again, just looking at how to aggregate equipment, resources, share costs where possible, I think is an avenue that will provide sort of work programs to be carried out faster, be more economical, and the better results are, the more investment opportunities will be around for new players, new investment.
Great, thank you so much.
Thank you.
Great, thank you so much, Joe, for your answers. Thank you all for joining today's webinar. We have a lot of questions from the audience, but respectfully for our time and for our speakers, hopefully I will be sending these questions to the speakers as well. Once again, thank you so much for joining the webinar. We look forward to having you in the 5th Timor-Leste Energy Mining and Business Forum in Dili, hopefully in November 24th to the 26th, to see you there, and of course to talk to you all. So thank you so much for joining the webinar. I wish you all a great day ahead, and thank you once again, and have a great day ahead.
Thank you, and see you all in Timor soon. Thank you.
See you in Timor.